Welcome to Herb W. Morgan's Slaying Bulls and Bears, a podcast about economics, markets, investing, politics, and profit. Every Monday, in less than 20 minutes, Wall Street portfolio manager Herb W. Morgan distills the complex and complicated into the simple and sensical. Here's Herb now.
Good morning, everybody. It's Monday, July 1st, 2024. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary, slaying bulls and bears, trying to make the complex and complicated simple and sensical. Presentation you are seeing and or hearing has been developed by us, Cantor Fitzgerald Investment Advisors. It is designed to be used with both financial advisors and individual investors, but everyone is expected to make their own investment decisions. Nothing contained in the presentation should be treated as investment advice, tax advice, recommendation for the buy or sell any securities. The views expressed are mine and mine alone and do not necessarily represent Cantor Fitzgerald, other affiliates, other portfolio managers, or strategists within the firm. Let's get into it. We had an interesting week because large cap stocks were, I'm going to call that flat, down 6 basis points. But look at small cap. You remember the last couple of weeks I've been talking to you about this valuation gap and difference. Maybe somebody listened and decided to go out there and buy. Clearly, it's just a week. Doesn't mean a whole lot at this point, but that valuation story is compelling. On the other hand, there's a lot to be said for the continued rally in large cap stocks, particularly in big cap technology. As we are getting ready to go into another earnings season, first we'll get the financials in about 10 days from now, and then we'll move on to the other sectors, part of which will be big tech, and I would not expect them to be anything other than great, the earnings that is. International markets up a little bit. China, CSI 300 index down 0.75%. Fixed income down as rates edged back a little higher. High yield, as the economy remains in growth mode, stayed solid, had a bid, and continues to maintain pretty tight credit spreads. Let's get into the data from last week. We got a number of data points on housing, residential real estate, something that's important to pretty much everybody's balance sheet. Let's start with the FHFA house price index. Rose 0.2%, a little bit less than expected, but a rise nonetheless, and is up. Home prices by this measure are up about 6.3% year over year. If you remember going back a couple of months, that year over year number was higher. So we're seeing some cooling there, but not really too much. You look at the S&P Case-Shiller house price index, just a different company measuring it a different way. They say we're up 38 basis points in April and 7.2% on a year-over-year basis. But higher interest rates are definitely hitting residential real estate market hard. All the businesses that surround that and support that industry or support home building, home buying. In May, for example, pending home sales down 2.1%. They were expected to actually be up 0.5%. That's on top of a big drop in April. And pending home sales are about 6.5% lower than they were this time 1 year ago. I think that it's a direct causation being the higher mortgage rates. Just no question about it. New home sales also suffering a similar fate. Volume-wise, down 11.3% in the month of May. The estimate was for 0.2, so they weren't even close to getting that number right in terms of the estimates. Down to an annualized pace of new home sales of 619,000. That's about half of what's needed. In other words, new homes needed for the growth of the economy, the growth of the population, and replacing stock that gets destroyed or is otherwise obsolete. We need about 1.1 million, 1.2 million, and new home sales are going at around 619,000 pace. That's pretty much a low for that kind of industry. Moving on to consumers. Consumers told the conference board that they're a little bit less confident about the economy in June than they were in May. Not much of a change, a small change, still well below. When you look at this, you look at the sort of 16, 17, 18, 19, kind of those boom years, particularly after the Tax Cut and Jobs Act of 2017. You can see consumer confidence, 110, 120, 130. Obviously the drop for COVID, it's recovered, but never gotten back to that level of confidence, almost ebullience that we had back at that period. Initial claims for unemployment, which we get, as you know, every Thursday morning, came in at 233,000. Remember, the last 3 or 4 weeks, we've seen it pick up off that 200 level. And so there's concern, is this, big, we're getting into job losses, which means the Fed would have to cut rates sooner. Not really happening. 233 is just a very, very low number. But what we are seeing is continuing claims rising. They're rising modestly, but they are rising. So continuing claims for unemployment, something to start watching a little more closely for trying to figure out when the Fed might act. It's not just inflation, it's also the full employment and the employment picture. We got first quarter GDP, we got the revision. Originally come in at 1.3, revised up to 1.4, but just like every drop is not bad and every gain is not good, I would put this one as a not so good. Well, why? If it was 1.3 went up to 1.4, well, the most important component to GDP for determining the overall health of the economy, in my opinion, is personal consumption. And that was revised pretty significantly lower, from a 2% growth rate to a 1.5% growth rate. It's telling you now that the consumers are feeling the effects of higher consumer prices, i.e. the inflation, and they are feeling the effects of the higher interest rates for purchases, credit cards, mortgages, you name it. There's no doubt now that the economy is slowing. There's also no doubt now that the inflation is coming down significantly and back towards the Fed's 2% target. Further information to support this idea that the economy is definitely slowed along with inflation. Take a look at the most recent readings and then the prior periods. Some of these are quarters, some of these are months. So personal consumption, okay, 1.5, but in the prior quarter, it was 3.3. So that's Q1 to Q4. Capital goods orders had been up 0.3. The prior month down 0.6. Core capital goods shipments up 4 to down 0.5. Pending home sales, both miserable. Continuing claims for unemployment, there's that slow tick up. 182 to 184. That's just from 1 week, not a big deal. And merchandise trade deficit got a little bit bigger as well. That's a quarterly number. It's really telling us that the Fed rate hikes, the Fed balance sheet runoff, which is the deprinting of money, is having the intended effect. We're seeing it in the inflation numbers. Now we're seeing it in all sorts of numbers on the economy. One of the indicators I like to look at is I want to see when data comes out each week. I always put in there what it came out at, what the estimate was. And if it's better than the estimate, that's considered a positive surprise. And if it's worse than the estimate, it's a negative surprise. So Citi adds up all those surprises, either above or below the estimate. And when you see numbers starting to really go up, more surprises, more and more surprises, that's usually a sign the economy is turning higher. When you see it get negative and go below zero, that means there are more negative surprises than positive. And you can see the lowest number, the lowest reading here, at least going back to 2023, doesn't always precede a recession by any means, but this is clear evidence that the Fed needs now to figure out when they're going to make that first interest rate cut. We also got durable goods orders for the month of May. Last week, they were up 0.1%, actually better than expected. Backing out transportation, they fell 0.1%. Nothing overly alarming there. We also got good numbers for May. Personal income and spending income is up 0.5%, spending up 0.2%. And then the most important report, the most important reading we got last week was inflation. And inflation as measured by personal consumption expenditure, PCE is the blue line. The red line is core PCE, which backs out the volatile food and energy components. For the Fed to determine, they set this themselves. They have a statutory mandate to maintain price stability. They define it themselves. Could be 0% inflation, but they define it as 2% inflation. And they define it as 2% as measured by this core PCE indicator. And as you can see, that red line, which had gotten close to 6%, is now solidly for several months now below 3%. And for the month of May, it was up a tenth. Regular PCE was flat. Both are 2.6% year over year, down considerably. We'll have some rough months begin to roll off here, and more of these 0 and 0.1 and 0.2% months rolling on. We're going to get back down to that Fed's targeted level. We also heard, finally, we did hear from the University of Michigan last week on consumer sentiment. It kind of goes along with that conference board and really tells the same story. They say consumer sentiment fell from 69 to 68.2. That was better than expected, but we're kind of near cycle lows here. Again, you go back, 90, 95, 100 on this reading. And despite, solid jobs, solid market conditions for the stock market, portfolios, household net worth, corporate profits, we're just like with the conference board, Michigan, we're just not seeing it getting there. And the reason, of course, is is prices. It's inflation, and that's what's getting people, the majority of us, who that's very important for, getting them sort of unsatisfied. This week, a fair amount of data. We've got the final S&P Global Manufacturing PMI along with the final ISM. S&P Global is expected to show expansion. ISM is expected to show a tiny bit of contraction. We'll get those later this morning, along with construction spending. JOLTS, or job openings, continue to come down. We were at 12 million plus just a couple of years ago, and we're looking like we're going to be at 7.8, 7.9 here on Tuesday. Auto sales looking to be around 15.9, 16 million. We've got the ADP jobs report on Wednesday and the Bureau of Labor Statistics big jobs report on Friday, coupled with trade, weekly claims. The services readings from both S&P Global and ISM, both expected above 50 minutes from the June FOMC meeting. That could give us some indication of when the first rate cut might be, but I don't really think it will. I think they're going to be data dependent unless we see further signs of slowdown. There's no reason that they have to cut imminently. It's not like they're going to overshoot the 2% inflation target on the downside. Thanks for tuning in. Don't forget, Slaying Bulls and Bears, making complex and complicated simple and sensical. Available on the YouTube channel or on any of your favorite podcast formats. Thanks, everybody. Be back to you again.
Thank you for listening to Slaying Bulls and Bears. If you'd like to download the slides for this week's podcast, go to www.efficient-portfolios.com and join our mailing list. Don't forget to subscribe to our YouTube channel, rate us online, and share with a friend if you found this helpful. See you next week.